Hi, I am Anna. I come from www.ntvforex.com. $S bounce nearly over analysis. http ntvforex.com news ID AAD103914 10:56 10 am. Often, there seem to be one or two drivers of the foreign exchange market, but now there are several cross currents. Sterling's weakness is a phenomenon of its own making. US-China tensions continue to run high as Washington has ratcheted up pressure on China and is insisting on the September 15 deadline for TikTok to change ownership or be banned. Beijing would rather see it shuttered than sold. The high-flying US Nasdaq has pulled back from the record highs set at the start of the month by 10%, but bottom picker have been met with overhead supply and profit-taking. Oil prices moved sharply lower for the second consecutive week. November Brent fell around 12%, and October WTI tumbled 14% over the past 2 weeks to levels not seen in 3 or 4 months. Then there is the dynamic within the foreign exchange market itself. On September 1, the euro pushed above $1.20, sterling was approaching $1.35, and the Australian dollar poked above $0.7400. The greenback pushed below $1.30 for the first time since January. Comments by the ECB's Lane about the role of the exchange rate as an input into its economic models and forecasts spurred a dollar short squeeze rally. We had anticipated that after the ECB meeting was out of the way, the market's attention would turn to the FOMC meeting September 15, 16, where the outcome is likely to reinforce the dovish implications of adopting an average inflation target, around which there is extensive strategic ambiguity. Below we fine-tune this scenario. Dollar index with a couple of minor even if notable exceptions. The dollar index has been confined to a 92.00–94.00 trading range since late July. It has been trending broadly sideways. It traded at its highest level in nearly a month in the middle of last week near 93.65, just above the upper Bollinger Band for the first time in several months. The MACDs are trending higher, and the slow stochastic is just below overbought territory. The 92.70 level seen around last week's ECB meeting corresponds to a 50% retracement of the rally from September 1. A move above the 94.00 area would target 94.75–95.50. The euro snapped a 6-day slide in the middle of last week, a day before the ECB meeting. It will begin the new week with a 3-day advance in tow. Lagarde's effort to downplay the euro's strength saw the market bid it a few ticks through the 61.8% retracement objective of the slide that began after it poked above $1.20 on September 1. Both the MACD and slow stochastics have nearly completely unwound the stretched condition and appear poised to turn higher in the coming days. We continue to believe the break from this range takes place to the upside, but the range affair can persist a bit longer. Japanese yen. The dollar has been in an exceptionally narrow trading range against the Japanese yen. The nearly 60 pip range was among the smallest weekly ranges of the year. It did not stray more than 30 pips in either direction of 106 Japanese yen and 10 sen. For the third consecutive week, the dollar recorded lower highs and higher lows. The momentum indicators do not appear helpful. More broadly, the dollar is hovering around the middle of a 105 Japanese yen to 107 Japanese yen trading range. British pound sterling was pounded last week. It was marked down by almost 3.7%, the most in 6 months. Part of it was dollar strength. After all, the greenback strengthened against most of the major currencies. However, the real driver was reneging on the withdrawal agreement that is seen as making a disorderly exit from the standstill agreement more likely. The Bank of England meets next week, and some groundwork for additional easing as early as November seems reasonable to expect. Sterling was pushing toward $1.35 on September 1 and made a low ahead of the weekend just below $1.2765. The 200-day moving average is near $1.2735, and the 61.8% retracement of the rally since the end of June is about $1.2710. The 38.2% retracement of the rally since the March low is a little below $1.2700. The next important retracement 50% is closer to $1.2455. Initial resistance now is likely around $1.2950. Canadian dollar. The US dollar rose in 4 of last week's 5 sessions to snap an 8-week slide against the Canadian dollar. It was only the second weekly advance here in Q3. The bounce faded in the middle of the week near 1.3260 Canadian dollars, a few ticks ahead of the 38.2% retracement of the decline since the end of June. The next retracement objective 50% is around 1.3320 Canadian dollars. The 5-day moving average has crossed above the 20-day for the first time since July, and the momentum indicators are trending higher. A loss of 1.3100 Canadian dollars would confirm the correction is over. Australian dollar. The pullback from the high above $0.7400 on September 1 stopped at the 38.2% retracement of the leg up from the end of June found near $0.7190. Initial support is now pegged around $0.7240. The MACD is still headed lower, but the slow stochastic appears to be bottoming. A move above last week's high near $0.7330 would likely confirm the correction is over, and another run higher has begun. Mexican peso. The greenback's slide was extended for the 5th consecutive week against the Mexican peso. In an outside down day on Wednesday, the dollar was pushed below the 200-day moving average 21 Mexican pesos and 59 centavos for the first time since before the pandemic. It has not been able to resurface above it. The next big target is 21 Mexican pesos. The momentum indicators are not helpful here, but it has been fraying the lower Bollinger Band 21 Mexican pesos and 30 centavos. A modest bounce just to the 20-day moving average 21 Mexican pesos and 82 centavos, the middle of the Bollinger Band, would be a large move of a couple percentage points. Chinese yuan. The greenback's downtrend against the redback has now extended for the 7th consecutive week. It has risen in only 1 week so far in Q3. Since the end of June, the dollar has fallen by about 3.5% against the yuan. Given that it is so highly managed, one must conclude that officials see the modest strength as desirable. Some benefits: cheaper imports from the US may attract international capital, as market liberalization measures, some of which are part of the US-China trade agreement, are implemented. It is difficult to know how far officials will allow things to go, but a near-term trading range between roughly CNY 6.81 to CNY 6.86 may be emerging. Gold. The lower end of the recent trading range around $1,900 was successfully tested last Tuesday, and the precious metal recovered to almost $1,967 before consolidating ahead of the weekend. The MACD and slow stochastic appear poised to turn higher. While a gain above $1,970 will appear constructive, gold has not been above $2,000 for a month now. Oil. October WTI fell for the second week for the first time since April. However, in recent sessions, a shelf has been carved in the $36.60 area, and the slow stochastic appears set to turn higher. That area also corresponds to a 38.2% retracement of the rally since those April lows. The next retracement target 50% is around $33.50. It managed to finish the week above the lower Bollinger Band $37.05. The $39.40 area may offer a formidable cap. U.S. rates. Both the core PPI and CPI readings were above consensus forecasts, but it did not prevent the 10-year yield from falling 5 basis points last week to about 66 BP. In early August, the yield spent a few days south of 60 BP, but since the middle of June, it has mostly held above it. At the same time, it has not been above 80 BP either, which is well below the current rate of CPI 1.3% and 1.7%, for the headline and core, respectively. The Treasury reopens previously sold 20-year bonds and 10-year tips in next week's auction. The 2-10-year yield curve eased to about 54 BP by the end of the week, which captures primarily the softer 10-year yield. The curve is at its 20-day average. The market anticipates a dovish Fed, noting downside risks and the lack of fiscal stimulus. S&P 500 an outside down day on Thursday saw follow-through selling ahead of the weekend that took the S&P 500 to a new low since the record high on September 2. The benchmark bounced back after approaching 3,300. It closed slightly higher ahead of the weekend, but not higher than it opened. The momentum indicators are still pointing lower. The 3,277 area houses the 38.2% retracement of the gains since the mid-June low. Pushing through, there could signal another 2% decline. A move back above 3,420 would stabilize the technical tone. A rally to new record highs was beyond the imagination in the dark days of March, and many have doubted it ever since the gap between Wall Street and Main Street makes it unsustainable. The question is whether this pullback marks the end of the rally, or is it a correction. While we still see it as most likely a correction, it does not mean that a bottom is in place. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.